Hey everybody, back with another video. Today we're going to talk about my 3 favorite monthly paying dividend stocks. And I know what you're thinking. Aren't monthly paying dividend stocks essentially a yield trap? A stock that offers a very alluring yield, but the fundamentals of the company or the financials are in ruins. I think you might be surprised that there are some quality dividend payers out there on a monthly basis. But first, let's get into a brief background about myself. If you're new to the channel, my name is Wayne. I'm 44 years old and I retired from law enforcement in 2020. And even though I did so with a generous pension, soon thereafter I began to regret a few things. First, not saving enough money. 2, not taking sooner advantage of tax-deferred contributions. And 3, not investing in the stock market. So today I've gone back to work full-time with a mission to generate multiple streams of income and build out that generational wealth. And one of the ways I wish to do that is investing in dividend stocks, quality dividend stocks. Take a look here at my screen. Currently, between my 2 main brokerages, I'm earning just under $13,000 a year in dividend income. I hope to get this number up to $15,000 by year end. And one of the ways that I'm doing so is focusing in on quality monthly pairs. Now, before you begin your dividend investment journey, you do have to kind of have some self-assessment as to where you are at. Again, I'm in my mid-40s, and right now, cash income is really, really important to me, but I don't necessarily fit into, well, I just want to focus on dividends, right? I want to build out those multiple streams of income. So that's kind of everything, guys. I am steadily contributing to tax or pre-tax contribution funds that are offered by my current employer. I am saving money, if you will, under my pillow. I'm investing in dividend stocks. I hope to get back into the real estate game this year. And again, dividend stocks, I think they hold a place in every investor's portfolio. But again, could you argue that there are better long-term growth dividend payers than these monthly stocks I'm going to talk about? Yeah, absolutely. So it really kind of comes back to that self-assessment and where you are at in your journey. So let's go ahead and get into the first one. And guys, first and foremost, I'm excited about this video because it really has forced me to learn more about the fundamentals of a business. And that is something that I, had a couple of missteps, if you will, since I began investing in 2021. I would just blindly invest in a company and not really understand what the business was, how it operated, how to look at the financials. So guys, I'm really excited about this video. I'm, by all means, still a newer investor learning about the steps to analyze and look at the fundamentals. And so yeah, a lot of work went into this video. Again, I'm not perfect. I may say a couple of things that are wrong. So of course, make sure that you guys are doing your own due diligence before you invest in any stocks or even add a stock to your watch list for that matter. So the first one is going to be Stag Industrials. And I want to kind of break down what Stag is. And I also want to mention that all of the 3 stocks that I'm going to talk about today, I want to make it very clear, they are actively in my portfolio and they are going to remain in my portfolio unless something crazy happens, as I begin to, or as I continuously follow these companies. So I'm never going to talk about a stock or recommend a stock that's not in my portfolio. And for full disclosure, Stag has been in my portfolio since December of 2021. So we're going to break down what Stag is. If you've never heard of it, you guys came to the right place. So Stag is an industrial REIT, R-E-I-T, and that stands for Real Estate Investment Trust. And there are a lot of REITs out there, a lot of choices. I personally think that Stag is a quality REIT. Now, this REIT focuses on the acquisition and operation of industrial properties throughout the U.S. And what I like about Stag is they have seen steady revenue growth. Let's go and take a look here at their website. And again, this was something exciting to me. I've never really gone to a company's website, and I actually learned a lot. Again, full disclosure, I've been investing since 2021, and this week was probably the first time I ever really learned about the fundamentals of this company. But you can see here, guys, all of the blue states represent where they have properties. I, of course, live in the Las Vegas area, so it was kind of exciting to see their footprint throughout the U.S. And so that is something that I would definitely recommend that you do if you are investing in this company. Let's take a look here at a recent article that I found on the Motley Fool, written earlier in the month. And it kind of talks about a decline, if you will, in revenue and some of the issues that can face industrial REITs like Stag. And I really like this because it kind of gives, again, a good breakdown of some of the concerns that you need to have. But I also took away from this some of their current clients, which includes Amazon, FedEx, some DHL supply chains. So again, you kind of have to ask yourself, yes, could we see, quote unquote, this mild recession in 2023? Absolutely. So one of the first things that I'm going to look at is the history of a company. And if we start right here with, I'm using Seeking Alpha, by the way, I always look at the 5-year. For me, it's one of the first things that I sort of learned as an investor. I remember my buddy telling me, man, always look at the 1 year and the 5-year. And he tells me, listen, the 1 year can be in shambles, right? Everybody can have a bad year. But looking at the 5-year kind of gives you sort of like, all right, like this company's got a pretty solid track record, at least for the 5 years. And so it's one of the big red flags I'll look for in a company. If I see that in the last 5 years, they've been in a steady decline, that's maybe a stock that I want to look a little bit more into before I invest. And that's the great thing about, I think, today's picks. All of them have seen revenue increases over the last 5 years. Stag has seen 43%. Let's go ahead and take a look at the year, though. They are down 11%. And I look at this as being a potential opportunity because 2022, I think as a whole, a lot of stocks saw a decrease, or they were in the red. So I am excited because I really do want to pick up some additional shares of Stag. I'm kind of in this sort of like dilemma where I've got so many stocks in my portfolio. I've talked about this in other videos, but Stag is going to be in my portfolio for the very foreseeable future. Let's get into why I really love Stag amongst the financials. And that's the dividend. So let's go and take a look at this, guys. And if you guys didn't know, Stag has steadily been paying dividends for several years now. And I'm going to scroll down to the very bottom here. And I've got it in my notes here. Stag has never cut their dividend since switching to a monthly payer in October of 2013. So you can see, guys, way back in, 10 years ago now, they were paying 10 cents. And if we scroll up, and again, I'm using the NASDAQ dividend research tool that you can easily find. You guys can see here a steady increase of dividends. And if we look at the most recent dividend, which is January, you can see they've scheduled out up until March. Again, we're looking at 0.1225. That's a monthly pair. So I really like a stock that obviously has strong financials. We look at Stag here, right? A good solid last 5 years. If we look at the financials and if we hover over total revenue, guys, this is exactly what you want to see, right? Stocks that are moving up and to the right. And Stag has seen this steady revenue from 2012 to 2021. So that to me is a big plus. Is there more research that you would have to do before you add this to your watch list or your portfolio? Absolutely. But I like, looking at the 5-year, I'm looking at the dividend having never been cut. And guys, admittedly, there is, if you will, this psychological factor to receiving a monthly dividend versus a quarterly dividend. And right now, generating cash flow is so important to me because I am focusing in on buying quality stocks that may not have a very high dividend yield. So, I'm kind of getting the best of both worlds. I have a solid position in Stag. I'm using those monthly dividends, and I'm not necessarily reinvesting back into Stag, but yet I'm investing in other stocks that I want to purchase in 2023. Let's go ahead and take a look here at my Track Your Dividend site. And you guys can see here when I type in STAG, I currently own 423 shares. So I was serious when I said that I am a long-term investor in STAG. I intend to hold and build these shares up. And right now, my cost basis is $33 and a penny. You guys can see here just in the last month, if we go back to the summary, STAG has had a pretty good increase. And I think, by and large, January has been a great turnaround, if you will, for the market as a whole. But 9% increase we've seen in the last month, guys. So I am optimistic. Even though if you look at the industrial REIT sector, right, there are some cautions, some concerns that should be in the back of your mind. But again, I'm very excited about this cost basis. So 33.01 is my cost basis for those 423 shares. Currently, the share price is 35.80. So, I've got a profit of $1,100 plus, an unrealized gain, if you will. And take a look, guys, at the dividend yield and the yield on cost. It's always a good thing if the yield on cost is higher than the current dividend yield. And right now, with the current shares that I have, I'm generating annual income of just over $600 a year. So that's fantastic. That's, obviously a pretty big percentage in my annual income pie. And again, STAG for me is going to be around for a while. Let's go ahead and take a look here at my next stock, and that's going to be Main Street Capital. Main Street Capital, again, full disclosure, has been in my portfolio since December of 2021. It's kind of funny, right? All of the three stocks I'm going to talk about today, I must have, caught this, quality monthly paying dividend bug at the end of 2021. Now, Main Street Capital is an investment firm primarily investing in the underserved lower middle market. And now it is a BDC, and BDC stands for Business Development Corporation. And you need to remember that because of BDC's tax structure. That is something that I'm a little nervous about, admittedly, this year. If you are holding REITs or you're holding BDCs, you may sort of see a difference as far as how these dividends are taxed. And so that's kind of the downside to my current brokerages. I do not have a Roth IRA. It is something that I deeply regret not having in my earlier workforce years, when obviously, I was not exceeding the yearly income threshold. Now, something that I am excited about, just this past year, I learned about what they are calling a backdoor Roth. I do intend to do that. And, if you guys are thinking about adding these monthly payers, you do need to look at the tax implications, and maybe that would be a reason as to why you want to hold, Main or even STAG in your Roth account, because all of those earned dividends and that growth is going to be tax-free. So you do need to also understand the difference between holding these monthly payers in a taxable account or a tax-free or even a tax-deferred account. So with BDCs, they must return 90% of their taxable income to investors each year. And analysts have described Maine as having one of the most secure dividend streams in the BDC sector. Now, since switching to becoming a monthly payer in September of 2008, guys, this is fantastic. Maine has never decreased its dividend. That, in my opinion, guys, is very solid history. So let's go ahead and take a look at the 5-year chart, and you guys can see, once again, I like to invest, whether it's a monthly pair, a quarterly pair, a long-term hold, I like to look at the 5-year chart, and you guys can see that they're up nearly 7%. For the 1 year, yes, just like we saw with STAG, they are down slightly for the year, just under 7%. Take a look here at the weekly range. That's something I didn't talk about with STAG. I think this is also important, why you want to daily cost average, and whether you're making purchases daily, weekly, monthly. That has been how, if we go back to, STAG, for example, it's not like I bought 100 shares, one time. I have, steadily been, contributing to buying STAG and Maine, and my third one we're going to talk about as well. Let's go and take a look here at the financials. Once again, guys, I'm not by any means able to dive in fully to all of these financials. I am still learning, but it stands to make sense. Let's go ahead and start off on looking at revenue. And once again, guys, if we hover over this, you can see, with the exception of December of 2020, revenue has been steadily increasing up into the right, as we like to see. And if we look at this, guys, it does look like in December of 2019, we saw revenue in the millions by 243. It did dip down to 222. But then, guys, look, December of 2021, seems like they're back on track. So, are you going to have companies that have just a perfect record, no blemishes, no down quarters or years? No. And that's why I kind of, look at the 5-year as a whole. Let's get into those dividends, and we'll start at the very bottom here. As I mentioned in my notes, September of 2008 is when they transitioned from a quarterly payer to a monthly payer. And once again, guys, they have never cut or decreased their dividend since 2008. And if we slowly scroll up here, guys, they've been 0.125. Then they moved up to 13 cents in 2011, slowly increasing to 14 cents, 15 cents. It does look like along the way they have paid some special dividends, and they made their way up all the way to 17 cents in 2014, up to 18 cents in 2015. I'll kind of wrap this up. You guys see the momentum as to where it's going. So currently, as a monthly payer, they are currently paying 22 cents per stock per month. To me, that's fantastic. I know you're not supposed to fall in love with your stocks, but guys, I absolutely love Maine. Let's go ahead and take a look here. Now, this is unique because I actually hold Maine both in my Robinhood and in my M1 brokerage account. And I'll kind of, the quick rundown on that is I recently was assigned 100 shares of Maine on a cash secured put in Robinhood, and I immediately turned around and sold a covered call. So that's why I have not pushed over all of the stocks that I own of Maine. But total between both brokerages, I do own 203 shares. Again, guys, this has been in my portfolio since December of 2021, slowly doing daily cost averaging. My average cost, guys, is $39.20. You guys can see here the current share price, $39.58. So I've got, a slight unrealized profit of just over 75 bucks. And once again, guys, this should always be a goal. I know it's a goal of mine. Anytime your yield on cost is more than your dividend yield, you're doing something right. If we actually look at Maine in my M1 only account, I think I've got a better cost basis, and I do, guys. Take a look here, 38.42. So a little bit better yield on cost, a little bit more unrealized profit, and again, I own 103 shares in M1. In Robinhood, I already know it's going to be $40 because that was the cash secured put that I sold, and you guys can see right here, this cash secured put was assigned to me. Again, $40 a share. I own 100 shares. So if we're factoring just the Robinhood holdings, I am down slightly, just over 40 bucks. And the yield on cost is not exceeding the dividend yield. But again, that's okay. I do intend to hold Maine for the long time. And so that's why you've got that blended average cost of $39.20. Again, guys, I think Maine has been a solid addition to my portfolio. And so let's go ahead and get into the last one I'll talk about, and that's O Realty Income. And guys, I got to give a shout out, man. I'll tell you, Ryan Williams is a buddy of mine. And, I shoot him text messages and I love his content. And so I got to give a big shout out to him because he just put out what I thought was a fantastic video. Anytime quality content creators are talking about stocks that you are holding in your portfolio, and I've been holding on to O. I've been investing. Once again, it's been in my portfolio since December of 2021. So if you guys have not yet watched his video, if you are not a subscriber, what are you waiting for, guys? It is quality content, and my man does a way better job of breaking down these financials, and certainly does so in this video. And he calls O Realty the Mona Lisa of dividend stocks, and I could not agree with him more. Let's go ahead and take a look at Seeking Alpha, starting with that 5-year, guys, 34%, right, that we've seen over the last 5 years. That's always a great thing to see. The 1 year, all right, if you look at the S&P and the other indices that are out there, right, it absolutely had a fantastic year considering it's green for the year with just under 1%. Let's go ahead and take a look at the 52-week range, right, $55 all the way as high as 76.06. So what is O Realty Income? It is known as the monthly dividend company, and they are structured as a commercial REIT with over 11,000 properties. They've been in business, guys, for the last 54 years. This is the kicker right here. Since 1994, they have increased their dividend a total of 118 times, guys. So if you guys are not familiar with O Realty Income, let's just go ahead and take a look here at their top 10 industries. And again, I love their website. You know, when you invest in a company, a quality company like O, you know, it seems to me like it's always reflected in their website. So whether you're in business with O or you're a shareholder, you know, this information to me is just gold. And I go back to, you know, as a newer investor, somebody that's beginning to learn how to look at the financials, you know, this to me is how you do things right. So it kind of breaks down their top, if you will, 10 industries. We've got grocery stores, convenience stores, dollar stores, restaurants that offer quick services, drugstores, restaurants in the casual dining section, home improvement, health and fitness, automated services. So guys, take a look at this. You know, I'm in the Las Vegas area, so some of these companies that we don't necessarily see, I don't think we have any Tesco's. We don't have any B&Qs, if I'm not mistaken. But guys, Dollar General, right? They're everywhere. Walgreens, they're everywhere. 7-Elevens, Dollar Tree. And I bring this up because even if you said, well, Wayne, you know, I'm not too sold on the commercial REIT industry, right? Look at COVID and the effects of COVID. And you're absolutely right. Do I think that if we ever had another bout of COVID, do I think that Lifetime Fitness would be open? No. I mean, they closed the gym that I went down during COVID. Do I think that Regal Cinemas would thrive during COVID? No, it absolutely did not. And a lot of the cinemas that are out there, they're still struggling post-COVID. So, but again, do I think that FedEx would be in business? Absolutely. Do I think 7-Elevens are going anywhere, right? You could have like a zombie apocalypse, right? There's going to be 7-Elevens that those zombies are roaming around in. So that's why I really like the diversification of Realty Income. And I want to point out here that O Realty is a dividend aristocrat. And if you guys don't know what a dividend aristocrat is, right here it kind of breaks down what the requirements are, right? The company has to be in the S&P, and it has to increase its base dividend every year for the last 25 consecutive years. And I always like to go, to that dividend aristocrat list. I want to see how many of my holdings on there. And guys, it just brings a smile to my face when I go on there and I see, I mean, maybe not like, a large percentage of the stocks, but certainly, right, O Realty is right there, and you guys can see 28 years of consecutive dividend growth. So that's fantastic. Let's go ahead and take a look here at my Track My Dividends. I am holding O Realty exclusively in my M1, and you guys can see here, O Realty, I own 204 shares. Again, I've been this has been in my portfolio since December of 2021, and my cost basis on this, guys, is $62.69. Let's go ahead and take a look here at the year. We saw a 1% increase, but guys, the last month, just like we saw with Maine and Stag, and quite honestly, the market as a whole, January has been a fantastic rally for O Realty, nearly 7% in increase. So we go back here to my cost basis of $62.69. The current share price is $68.30. And anytime I see this, I'm like, why did I not invest, right? Why did I not buy more shares of this solid Mona Lisa, if you will, of monthly pairs. So 204 shares, guys, that's about $610 of annual income in my dividend pairs. And so I couldn't be more thrilled about these three holdings. Again, it's not financial advice. It's sort of, insight as to what I'm holding on to. I've got a lot of monthly pairs. And if you guys have not seen a video that I posted earlier in the year, it's one of my newer videos, or I'm sorry, one of my first videos, I should say. I mean, guys, I'm so new to this whole thing, so I sometimes go back and watch older videos and I absolutely cringe. Don't worry, I'll be cringing at this one as well in a few months. So in going back to that previous video, you guys may have seen that one of the best purchases I made in 2022 as far as stocks was JEPI. So you might be wondering, well, Wayne, you talk about JEPI in other videos. Obviously, it was in your, top 5 picks of stocks you purchased in 2022. Why is JEPI not on your list? And guys, it's real simple. I love JEPI. JEPI has a place in my portfolio. As you guys know, it's a covered call ETF. It's a monthly pair. But what I don't like about JEPI is that it has a varying monthly dividend. So whereas when you look at Main Street Capital, right, I can look even ahead and know that I'm going to make this much money per share in the foreseeable future. If you look at Stag, it's the same thing, guys. I can count on that, very static number on a monthly basis. And of course, O is no different as well. I don't have, you know what? I should have pulled up O, and that's okay, guys. You know what? Let me go ahead and type this in real quick. O Realty. Let's see, why didn't that? Realty income, of course, the one time. Oh, there we go. So let's go back and take a look here at this chart, and we'll scroll back. I mean, we'll go, starting with 2011, you guys can see here 14 cents. And then over the years, it worked its way up to 18 cents by 2013, 19 cents by 2015. And we work our way all the way to the very top, guys. And O is currently paying about 24 cents per share every single month. Those are the stats that I like to look at. Hey, once again, guys, I really appreciate you following me along on this rambling, epic video, if you will, time-wise. You guys have been fantastic. If you enjoyed the content, please continue to follow along. Go ahead and smash that like button. And guys, we will see you on the next one. Thank you so very much.